Today we're going to start our multi-step process for building out a reusable valuation model, which is tied to Bloomberg, based on the company SBUX. So again, you have the start file in Elms that you'll be using to build along with me. You're going to be creating along with me. So where this file started from, back to Excel here, is you had an assignment earlier where you created a exportable series of 6 historical years of raw data, income statement, balance sheet on any company. We're using that exportable file, which I've done for SBUX, replaced all the dashes with zeros. That's our raw income statement, balance sheet data, just a whole bunch of fields. What I've then done is I've started to build, so you didn't start completely from scratch. In our start file, it has a series of tabs that work from left to right. The one on the left is called model data. That is that data dump that came from Bloomberg, the raw data, okay? And by the way, that's how we'll update the model in the future. So we'll just copy paste over all the data field for field here. So if we were doing Boeing, don't know why we'd want to do that company today, but in any event, we do Boeing, then we could copy and paste, replace SBUX with Boeing, and then we could do the valuation or pick a company. So that's how we're going to start building a reusable model. So what I've done is I've taken the model data, and if you go to the income tab, created a standardized 6 years of historical income statements, which come from that model raw data. So Bloomberg, which doesn't have pure standardized statements, I tried to create a modified version of their standardized statements, but nonetheless, we have a standardized income statement, and on the balance tab, we have a standardized balance sheet. Something you would have appreciated before. I then took these standardized statements and I created a TFI, auto mapped, so it auto does the TFI, which balances, a TII, and more importantly, a CFI. So the economic statements are also in this model, which correctly map to the income statement and balance sheet and will auto balance and auto be created, along with EPBOY and EPEOY tabs for economic profit. And then the final tab in the model is an ROIC tree. So the ROIC trees that will be used will be auto-generated based on historical data from the model. Okay, so all of that comes from importing the historical data. All right, so what we're going to start doing is the final 2 important tabs are the ratios tab and the assumptions tab. So best practice is that when you build a complex Excel model, you want to put the inputs that you change in as few places as possible, ideally 1 place, right? In our model, they're going to be in 2 tabs. They're going to be on assumptions and ratios, right? And the reason for that is if you build this very complex model and you start spreading your changeable assumptions throughout the model, I guarantee you, you'll forget where something is, and it will frustrate you. So ideally, putting it all in a centralized location helps you as you start to change a reusable model. So one of the things I've also done is I chose the color yellow a number of years ago to represent fields that you can change. Because the other thing is we're going to make references throughout the models and formulas, and you don't want to break the model and overwrite it. And since we're building the model, I didn't protect any of the tabs. Okay, so you could go in there and do great harm to this model if you break a formula. So in order to understand later what we can change and what we shouldn't change, things that we can change are yellow. Those will be the things that we can change in forecast. That's the convention that I have chose to use in this model. So you can see, for example, WACC. If I want to change the WACC, type in a new WACC. Because this, again, it's a yellow cell, says I can change it. All right, but where we're going to start is in the ratios. Because the other best practice is that when we forecast statements, we don't directly forecast the statements. What we do is we forecast the ratios, and the forecasted ratios create the forecasted statements. So this is 6 historical years of income statement and balance sheet ratios. Everything is a percentage of sales with the exception of the revenue growth rate, which is a percentage change. Okay, and so again, you have all these historical ratios. And so what we're about to start, so here's where you're going to start building the model with me, is we're going to create a 6-year forecast for, in this case, SBUX. Okay, so we have the historical data in here. We're now going to create a forecast. And so as part of that, we're going to make some changes. So the first change is starting in cell H1. We're going to highlight that this is a forecast by typing in forecast here. So I can separate my historical versus forecast data. There's a lot of data in this tab. For cell H2, my first forecast year equals previous year plus 1. So G2 plus 1. So 2019. And again, I don't want to hard code in a year because if new data comes out, I want the model to automatically adjust. Okay, so that's why it's previous year plus 1, relative years. And then the next line item is revenue growth rate. Now, eventually we're going to forecast a real growth rate for Starbucks as part of the valuation, but for now we're just going to use a placeholder so that we can eventually forecast it and we all see the number that we're working on together. So for revenue growth rate equals the previous year. So for H3, excuse me, equals G3. And that is a cell that I want to make yellow to tell myself that this is something I will eventually change. Right? Now, how will this work? Just to be representative, I'll go to the income tab. And these are 6 historical years. Don't do this, and just because the screen is small, I am going to hide some of these historical years just so that you can see what I'm doing over here on the right. If you choose to hide, don't delete. Killing the historical years will destroy your model. So I'm just showing this so you can see what I'm doing over on the right. So on the income tab, we're going to create a forecast. So you want to do that too. Equals previous year plus 1. And to get revenue for 2019, we're going to take, so for cell H3, equals G3 times left paren 1 plus ratios H3, which is 2019 revenue growth rate, right paren. So if, and I'm going to format all of this, highlight all this as currency 1 decimal place, just to match the previous columns. So if Starbucks were to grow an additional 10.4% next year, their revenue would be 27,295.3. Now, I don't want you to hard code that number in for percentage change. I want you to equal the previous year, so we exactly match. But the point is, we could change that. Don't do what I'm about to do. So this one, don't do. But here's an example of where we'll eventually go. If Starbucks next year were to grow 7%, type in 7, 26,449.9. So that's what I'm saying. So what we're setting up is, as we put in these ratios, the changes in the ratios will change the financial statements. That is a much better way of forecasting than directly forecasting the statements. So essentially, that's what we're trying to build here. So since we all want to have the same number, I don't want you to put the 7% in. I want you to leave the 10.4, equal the previous year. Right? But it's kind of the gist of what's going to start happening in the model. All right? The next income statement item that we're going to forecast is EBITDA. So for H7 equals the previous year. Now technically, and I'm going to make that yellow. Now technically, you could forecast cost of revenue and operating expenses, kind of the cost of goods sold and SG&A, but the model doesn't care because the model is going to be based on EBITDA and it's kind of window dressing. Now don't get me wrong, in the real world, companies will want you to do that granularity. You don't just go to EBITDA, you typically forecast the items above EBITDA, but practically it doesn't matter because EBITDA is the key driver for our valuation model. So I'm going to directly forecast EBITDA to make it a little bit more simplistic for you today. So we're going to also forecast depreciation and amortization as a percentage of sales. So for 2019 equals previous year. So H8 equals G8. And again, yellow, because it's something I could change. And then what we're going to do is we're going to solve operating income. You can see pluses and minuses eventually will be over there on the left in the income statement. But basically, EBITDA minus depreciation and amortization equals operating income. Now, because it's based on the two numbers above it, we're not directly forecasting operating income or EBIT. We're forecasting EBITDA and depreciation to create our operating income. Okay, so that one's not yellow. That one we're solving for. All right. Next, tax rate equals from the ratios tab, equals the 2018 tax rate. It's just going to repeat itself. So equals G10. Right. And again, that is something we can change. So I will make that yellow. And then the next one down is no plat. We're solving for no plat. So no plat equals operating income times left paren 1 minus the tax rate. Or if you want to be lazy, you can take cell G11, copy it, and paste it into H11 because the formula is in the previous cell. Okay, but it's basically operating income times 1 minus the tax rate is our no plat. Okay, and again, we're solving for that, so it's not yellow. And then the next one is non-operating gains and losses equals previous year. It's placeholder, make it yellow. So very quickly, we've created 5 key ratios that we're going to forecast for the income statement for SBUX. I'm going to take column H, I'm going to copy it, and I'm going to paste it through column M because we're going to forecast 6 years. 6 years is arbitrary. It's not necessarily a best practice, right? Read the book. But the idea is we have 5 defined years of forecast period, and the 6th year is the beginning of the continuing value or perpetuity period. Okay, so you always forecast an N+1. So that's what 2024 would be for SBUX. Now, from these ratios, we're going to go to the income tab and we're going to create the actual forecasted income statements. So again, off the income tab, I'll start with EBITDA for 2019. This is now in dollars. So for H8, which is EBITDA in 2019 off the income tab, equals from the ratios 2019 EBITDA as a percentage of sales. So H7 times from the income tab 2019 sales, which is H3. So if that comes true, EBITDA $5,729.9 million. Okay, that's our forecast for EBITDA. Not yellow because it's solved. Right? Same process for depreciation and amortization. As a percentage of sales equals off the ratios tab. 2019 D&A as a percentage of sales is H8 times from the income tab H3 2019 revenue. So 1442. Solve for operating income equals EBITDA minus the depreciation and amortization. So 4287.9. So that is our forecast for operating income / EBIT for SBUX for 2019. Now, for the next series of items, we're going to make some assumptions. You can always, in the future, override these assumptions that I'm making for simplicity, but generally they're not going to affect your valuation. It's really more for the window dressing on the statements that you'll have to create. One of the other key assumptions is also based on the fact that McKinsey talks about ideally when you do a DCF, an enterprise DCF, you want to do it with the idea of a target capital structure in mind, right? Now, if we don't know the capital structure, we're going to assume the current capital structure equals the target. But the point is, for simplicity, we're going to leave the debt and equity alone. Whatever debt they have, they're going to keep. Okay? Whatever equity they have, they're going to keep. We're not going to forecast in this model basically retirement of debt, issues of new debt. We're not going to forecast changes in dividends or stock buybacks. We're leaving the capital structure alone. So, for interest expense, whatever interest they're paying on the debt, we're going to keep paying, equal the previous year. If the company is making interest income on its excess cash, equals the previous year. Whatever it is, we're going to continue. Okay? For FX, foreign exchange gains and losses, 0. I don't know what SBUX's gains and losses are going to be in 2 years. They don't know. We can't predict currency that far out, so therefore we're not going to try and do it. just 0. And we're going to assume companies will try and hedge to be close to neutral positions, but nonetheless 0 because it's too hard to forecast. Okay. Next, income or loss from affiliates equals the previous year. Whatever they're gaining or losing from affiliate income, we're going to assume stays the same. Again, any one of these assumptions, if you really knew it for a company, you could always go in and update it. But right now, I'm simplifying. Okay. Next, non-operating gains and losses equals, from the ratios tab, 2019 non-operating gains and losses as a percentage of sales. So that's H12 times income H3, 2019 revenue. And that gets us to pre-tax income. So you can see again the pluses and minuses over here. So to get to pre-tax income, operating income minus interest expense plus interest income minus FX minus income or loss in affiliates minus non-operating gains or losses equals that. Or if you want to be lazy, I've already done that in cell G16. So you can just copy G16, paste it to H16. Word of warning, don't drag and drop. As far as you're concerned, in this class, with this model, drag and drop in Excel is banned. All right? It will destroy your model. I had a poor student earlier today who was dragging and dropping. His model was all screwed up. Because what happens in Microsoft is Microsoft, in its attempt to be your friend when you drag and drop, might create a series without telling you. They'll say, aha, this looks like a series. So I'm just going to keep adding 1, 2, 3, 4, 5 to all the numbers in the corresponding fields. And it doesn't tell you that it doesn't. So what I'm telling you is 98% of the time when you drag and drop, you're okay, but that 2% will come back to haunt you. It's already haunted somebody in the previous section. So copy, paste, right? Control Command C, Control Command V is you're going to be your friend throughout the semester, okay? So back to this, copy, paste, don't drag and drop. So you should get pre-tax income forecast for 2019, $6.4 billion. Okay, everybody got that so far? Yes. For which one? What'd you get for the one above? Do you have the 2282.4? Okay, so you got to just go back and check, follow up on the assumptions, or you can see me after class. And this is also being recorded on video. But as I said, you got to kind of follow along exactly. All right, next, income tax expense equals, for H17, from the ratios tab, H10, which is the tax rate that we're forecasting for 2019, times, from the income tab, 2019 pre-tax income, which is H16, 1397.4 in tax. Income before extraordinary items equals our pre-tax income minus the income tax, $5,002.6. Okay, so this is our forecast for income after tax. Next, we have extraordinary loss or gains. The definition of extraordinary items basically says they should never occur again. They're extraordinary. So therefore, 0. If you have a one-time item, it should be one time. Okay? If it's not one time, it should be up in operating expense. All right? So therefore, our net income before minority interest is the income before extraordinary items minus the extraordinary items. So again, didn't change, 5,002.6. Minority interest payments. Whatever changes in payments to the minorities they're making, we're leaving alone. All right? So whatever they paid to the minority shareholders, we're leaving alone. Okay? So they're just going to keep paying that same amount. So we're not changing the capital structure. Equal the previous year. Net income equals the net income before the minority shareholders minus the minority payments. Therefore, 5,002.9. And again, if you need help, you can also look at G22 to see what we're doing in H22. Cash preferred dividends. Starbucks is not paying preferred dividends right now, but other companies may. So again, whatever dividends are paying, they're going to keep paying. So equals the previous year. Other adjustments to equity, 0. These come from FASB and IFRS changes to accounting rules. So when the accountants change the rules, companies have to make adjustments to their statements. We don't know what the changes in the accounting rules in the future are going to be. And generally they don't impact taxes, and therefore they don't affect cash flow anyways, so therefore zero. Not too hard to forecast. So net income available to common shareholders equals above. So what I want you to do, very specifically, is copy G25 and paste it to H25 to solve for your net income available to common shareholders. The next one is dividends paid. Again, common dividends equals the previous year. So whatever dividends they're paying, they're going to keep paying. So H26 equals G26. Now, here's a word about data. So Bloomberg, who is our data source, is sending cost information as positive numbers. Cost of goods sold was a positive number. Depreciation was a positive number. But for whatever reason, Bloomberg is sending dividends paid as a negative number. And so this is where you just have to look at the formatting for your data source. So in Bloomberg, dividends are a negative number. In Bloomberg, costs are a positive number. They're not always consistent about cash flow. So here's the thing. Normally, to get our change in retained earnings, we would take our net income and subtract the dividends to get our change in retained earnings. What's left goes to shareholders. However, since Bloomberg is giving us a negative dividend, if we subtract a negative dividend, it would essentially add that number, and it would give us the wrong change in retained earnings. So even though normally we would subtract it, because of our data source, we need to add it. So adding a negative number. So equals net income to common plus dividends paid is change in retained earnings. By the way, if you're ever to change your data source, you go from Bloomberg to FactSet, you'd have to be careful because FactSet may give you data in a different format than Bloomberg. Okay, so you always have to kind of check your data source regardless of whatever formulas you're trying to use. By the way, that's why I had you copy cell G25 to H25, because the same is true for preferred dividends. Bloomberg lists preferred dividends as a negative number when you export it. So even though you're subtracting the preferred dividends, I am adding the negative preferred dividend in that formula in H25, just so you know. So you should get a change in retained earnings, 3259.5. Right? Home stretch for the income statement. So now take column H, select all of column H, copy it, and paste it through column M. And very quickly, we now have 5 years of forecasted income statements for Starbucks. Or sorry, 6 years, 5 additional years through 2024. Then go to your TII. This is your TII, which again should be balancing. So here's what I'm going to do. I'm going to take column G, copy it, paste it in column H, change column H to a forecast from history, take column H, copy it, and paste it through column M. So what we now should also have, and down here at the bottom is a balance check, but we should have 5 years of forecasted TII, or sorry, 6 years of forecasted TII, which now balance. Okay. So again, since the income statement was mapped to the TII and balanced, when we copy it forward, it should still stay mapped and balanced. So very quickly, we've created 6 years of forecasted income statements, which created 6 years of TII. Okay. And if you want to check, your 2024 TII should be 8430.3. Okay. Now, let's do the balance sheet. Similar process to the income statement. So for the balance sheet, we will start with a forecast, and I'm going to hide some of these historical years, again, just to make it easier for you to see what's happening on my screen. You don't have to do this. Okay, just I have a small compact projector. So again, this is my forecast starting in H1. H2 equals previous year plus 1. Again, I want to make relative references. And then I want to start forecasting out the balance sheet items. I'm going to do that by going to the ratios. These ratios down here, these 11 balance sheet ratios, starting with accounts and notes receivable, are a percentage of sales. Every one of these ratios is a percentage of sales. Okay? Now that is not a best practice, right? So for example, when you do accounts and notes receivable, it's a percentage of sales. When you do inventories, it should be a percentage of cost of goods sold. When you do accounts payable, it should be a percentage of cost of goods sold. That's the better practice. However, in this class, everything's going to be a percentage of sales for two reasons. One, simplicity, and two, it will be apparent later when we finish the valuation, but it actually will help us when we do our forecasted balance sheet valuations. So here's how we're going to do this. For cell H14, just as a placeholder, equal the previous year, make that yellow. And then, come on. And then copy cell H14 and paste it all the way down to M23. So that way we basically just have repeating, and again I'll hide a few columns so you can see what's going on here. We have repeating balance sheets. So everything just equals the previous year, repeating for 6 consecutive years. Again, we can change these assumptions later, but for now, as we build the model, this is how we're going to start. And if you haven't done this, save. Because it would be awful if along the way your model died and your computer crashed or something happened. So I'm going to save. Okay, so save frequently. All right, so based on these forecasted ratios of the balance sheet, we're now going to forecast the income statement. Or sorry, the balance sheet, the actual balance sheet. So let's go to the balance sheet tab. So for 2019, right, we have 11 ratios. So we're going to start forecasting those ratios. The first one is accounts and notes receivable. So that's H6. So equals, from the ratios tab, 2019 accounts and notes receivable, so that's H14 on ratios, times, from the income tab, H3, which is the 2019 revenue forecast. So if those come true, 765.32. And again, I'm going to take this column. I'm going to format this. Currency, 1 decimal place, just to match the previous formatting. So again, similar process. For unbilled revenue, which Starbucks does not have any, equals, from the ratios tab, 2019 unbilled revenue as a percentage of sales. So that's H15, times, from the income tab, 2019 forecasted revenue, H3. 0. Inventory equals, for 2019, from the ratios tab, 2019 inventory as a percentage of sales. So that's H16, times, from the income tab, 2019 revenue, which is H3. Other current assets, you're noticing a repeating pattern here, equals, from the ratios tab, 2019 other current assets as a percentage of sales, which is H17, times, from the income tab, H3, 2019 revenue forecast. Next is long-term investments, equals, ratios, 2019 long-term investments as a percentage of sales is H18, times, income tab, 2019 revenue is H3, 295.6. Net fixed assets equals ratios. 2019 net fixed assets forecast is H19 times income tab. 2019 revenue is H3, so 6546.9. Other long-term assets is the next ratio, so equals ratios H20 times income H3. Next one is accounts payable equals ratios 2019 accounts payable as a percentage of sales H21 times income H3. Short-term liabilities equals ratios 2019 other short-term liabilities H22 times income H3. And finally, other long-term liabilities equals ratios H23 times income 2019 forecasted revenue H3. And again, save along the way. But those represent the 11 balance sheet ratios as a percentage of sales forecasted based on 2019 revenue for SBUX, if that were to come true. So now what I'm going to do is we are going to finish off, so again, save. We're going to finish off the balance sheet. We need to balance the balance sheet, and more importantly, do it all without getting a circular reference. If your Excel model has a circular reference, it's an invalid model. It's not even going to be graded in this class. You should never have a circular reference in your model. So I'm going to show you how to create a forecasted model without a circular reference. Right? So in order to do that, we're going to finish off the balance sheet. We're going to start with equity. Preferred equity, which is H26, equals the previous year. Again, equals G28, sorry, H28 equals G28. So here's the idea. Whatever preferred shares they have, we're going to leave alone, since we're not mucking with the capital structure. So equals the previous year. Same thing with minority interest. Whatever minority shareholder interest they have, they keep that. So equals the previous year. Share capital and APIC, which is additional paid-in capital, equals the previous year. Because we're not issuing shares, we're not buying back shares. We're leaving the shares alone. The only thing that will change is retained earnings. So the change in retained earnings plus last year's retained earnings is this year's retained earnings. So for 2019 retained earnings equals 2018 retained earnings plus, from the income tab, 2019 change in retained earnings H27, so 4386.6. And if we sum those four items, we should now get the total equity of SBUX, 4435.3. Everybody with me? Questions? This one or the previous one? So that is going to be equal to G31, which is the 2018 retained earnings, historical, plus from the income tab H27, which is the change in retained earnings that we solved for at the bottom of 2019's income tab. Add that together, and that's your retained earnings. So last year's retained earnings plus the new change in retained earnings equals this year's retained earnings. And I just sum those four above it, and that's total equity. All right, so now let's finish off the liabilities. For short-term borrowings, equal the previous year. Whatever debt they have, we're leaving the interest alone, we're leaving the debt alone, equals the previous year. So our current liabilities equals the sum of the three above. The accounts payable, the short-term borrowings, and the short-term liabilities. So 6240. Long-term debt, long-term borrowings equals previous year. Again, we're leaving the debt alone. We're not issuing or retiring debt. Pension liabilities equal the previous year. If a company has a pension liability, eventually it's got to be repaid, so we're going to equal it, but they're not allowed to add to it. Governments and accountants have basically said over time, you're not allowed to keep having these big added pension liabilities. You've got to fund your pensions. So therefore, we're going to assume all new pensions will be funded, and whatever pension they have will be reduced. Again, if for some reason a company violates those rules and does it differently, you can always go back and adjust it, but generally we're assuming companies are following the rules. Okay? And then you add those three up, equals the sum, long-term borrowings, long-term liabilities, pension liabilities, sum it, and that'll get us our total long-term liabilities of 18,151.5. So our total liabilities is our current liabilities plus our long-term liabilities, which would be 24,391.5. And if we take our total liabilities of 24,391.5, so H27, and add that to our total equity, which is H32, we get total liabilities and equity of 28,826.9. Now, it's also critical that you turn in a balance sheet that balances, because if our balance sheet doesn't balance, we're going to have problems with our model. So the next step is going to be critical to making sure that you have a balanced balance sheet. So I'm going to show you how to create a forecasted balanced balance sheet. So take total assets, which is H16, equals total liabilities and equity, which is H33. There you go. It balances. It will always balance now. Okay? You don't have to worry about your unbalanced balance sheet. Okay? Told you, I give you the tips and the tricks. These are pro tools. But in all seriousness, it does mean, though, that we're going to have the concept of a plug to make sure that all of the assets add to that amount. Okay? So our model is going to have a plug. All right? And our plug is excess cash. So what we're going to do is we're going to solve for excess cash to keep the balance sheet correct. Right? So since we're going to solve for excess cash, I don't have to forecast excess cash, but there's two other non-total categories we haven't put on here yet: operating cash and goodwill. So let's do operating cash. So for operating cash in 2019 equals, from the assumptions tab, this is the operating cash as a percentage of revenue. So B3. So for whatever reason, I chose to make operating cash a universal assumption rather than a year-by-year change. That's why I put it on the assumptions tab. Ratios you can change every year. Assumptions are just one and done. Okay, so equals B3 times income 2019 forecasted revenue, which is H3. So 545.9. But there's one other thing we got to do this cell, because it's special. Edit that cell, and in front of the B and 3 in assumptions, put a $sign in front of the B and a $sign in front of the 3. Okay? So assumptions, string B, string 3, or $sign B, $sign 3, because what that tells Excel is to make that field an absolute reference, which means if you copy and paste it, it will always refer to B3. That's what the $sign B, $sign 3 does. And since there's only one cell, we don't want it to not refer to that cell, otherwise it'll just be 0 or some weird number. Okay, so then finally goodwill. Too difficult to forecast acquisitions. Nobody knows what they're going to be, much less how much people are going to pay and how much goodwill will be created, so we can't do it. And the good news is goodwill is now impaired, which means theoretically it could stay on the balance sheet forever, and then the accounts just have this arbitrary impairment rule that they'll apply from time to time. But even when they impair it, the further good news is it has no impact outside of a bunch of paper pushers, right? Because it doesn't impact taxes and therefore doesn't impact cash flow. So as a result, goodwill impairment is kind of irrelevant to our valuation, right? So here's the deal, but we got to have balancing statements. So what we're going to do is just equals the previous year for goodwill. Okay? Now we're ready to solve for excess cash. Excess cash equals total assets, H16, minus everything else, minus operating cash, minus H4, minus accounts and notes receivable, so that's minus H6, minus unbilled revenue, H7, minus inventory, H8, minus other current assets, H9, minus long-term investments, H11, minus net fixed assets, H12, minus goodwill, H13, minus other long-term assets, H14. When you hit enter, 11,954.2, but more importantly, a circular reference did not pop up. Okay? So we forecasted an auto balancing balance sheet that doesn't have a circular reference. Right? So now what we're going to do, we're just going to, for window dressing, put the lipstick on. So current assets equals the sum of everything above it. So H4 through H9. And long-term assets, which is H15, equals the sum of H11 through H14. And if we want to do a check, if I add current assets plus long-term assets, I should still get the same 28,826.9. So the point is, I still can add up with the plug the same assets, and I'll still get to the plugged total asset number. Okay, you don't have to do that extra step, but I'm just showing you that we still have a balancing balance sheet. Yes?
Do we still have a circular reference for excess cash?
If you did it wrong. There should be no circular references in your model.
No, would we still get a circular reference if we just subtracted total current assets and total assets?
You mean to get to excess cash? You could probably still get to it that way. But the key is you can't use excess cash in your formula. It means you can't just say add everything up to get to excess cash. You have to make sure that excess cash is around that. So your current assets couldn't include the excess cash in it, because if you had excess cash in your current assets, then you're using something to solve for something, and that's what becomes circular. That's where you'd run into trouble. Okay, but good question, right? Because I've seen a lot of people with circular references in the real world, and I don't like those models because by definition they're going to change every time you hit recalc, and that's just not a valid model as far as I'm concerned. And you don't have to do a valuation model with one, right? So back to this. Home stretch. Save. Don't want to lose what you did, especially since we're in the home stretch. So take 2019, copy it, go to column M, paste it, and we now have forecasted balancing balance sheets going through 2024. Then TFI. Go to your TFI tab. Take column G, copy it. Column H, paste it. Take H1, say forecast instead of history. Take column H, copy it. Go to column M as in Mary. Paste it, and we should now have TFIs, look at the balance check, which is row 22, that balance going through 2024. Which is important because the next tab is CFI. So same thing. Take column M CFI, copy it, put it in N, paste it. Oh, sorry. TI. Oh, sorry. We got to do TII as well. Take M, copy it. Oh, sorry. We already did this step. Sorry. Ignore. Go to CFI. Take column G, copy it, paste it into H, flip cell 1 to forecast. Take H, spell forecast right. Take column H with forecasted spelled right. Go to column M. And we now should have balancing CFIs through 2024. And here's the very important number that you should have for M36 should be 1876.2. If you did it correctly. If you don't have that number, you made a mistake. You got to go back and figure out what it was and fix it. But we should all be at that CFI, and we're almost done. Yes. Question? All right. So next, final tabs, economic profit based on beginning of year. Same thing. Take column G, copy it, paste it in column H, change it to forecast, and then take your 2019 forecasted economic profit and go through column M. So that's our EP, BOY economic profit, which again balances, and our EOY economic profit is the final tab. Copy it, paste, flip it to the forecast. And that should get us to 2024 based on economic profit, end of year economic profit. So again, that number in the EOY tab, should be 4279. So if you have 4279 in M24 of the EOY, and if you have CFI of 1876.2, then you're good. You've completed what we need to do for this video. Okay. Now, at this point, you're not going to turn in the file because there's one more class, one more video that we're going to do, which is basically in our next class, we're going to pick up from here, and then we're going to finish out the model. So what we've done today is we've taken SBUX, we've taken 6 years of historical data from Bloomberg that SBUX has reported, and we put it into this model with historical ratios and historical economic statements which balance. We then use those ratios to create forecasted ratios for SBUX, which created 6 years of forecasted financial statements, which were turned into economic form that balance. Right? And this is reusable because we can take any company now and export the data, put it in that first data tab, and it will repeat and basically do that and follow through. That's why we use all these relative references. What we're going to do next, so save this file before you turn it in, because you have to put the next part to it, is we're now going to take this forecasted cash flows and we're going to turn it into a valuation. So we're going to add a enterprise DCF valuation tab to the model so that we can actually do a valuation. And the next class, we'll do an actual valuation of SBUX based on their current share price. Now, eventually, what we're going to do is once that's the one you're going to turn in for a grade. Okay? And so again, you have to get to that point after that video. Right? Now, from there, we'll come back and we'll add in some additional things. We'll do a bull and a bear. So, for example, we do our target recommendation. We won't just do one stock price. We'll also do a range of what the stock prices can be. Talk to you about how to do that. Talk to you about how to use multiples to help you get basically a triangulation on the valuation and get some insight into some of the forecasted variables. So we're going to add more complexity, but today and the next class is basically the core of the model that we're building. So save where we are for today, bring it back for the next class, and then again, we'll continue to finish out the DCF valuation, and that's what you're going to turn in for your next homework assignment. Yes, sir?
When is the next one?
So